Welcome everyone. My name is Darshan Doshi. I'm the founding director for the Center for Entrepreneurship and Innovation here at Flame University. For those who don't know what Flame University is, it's India's first liberal education institute, which we've catered to the Indian audience, right? So what we've not tried to do is just copy paste the model of liberal education in the US and just bring it to India. We don't do that. What we've tried to do is make sure that it meets the Indian culture, the Indian mindset, the Indian needs, and offer interdisciplinary approach. Now, within entrepreneurship, it is meant to be interdisciplinary. You need to, as a founder, as a startup entrepreneur, you need to do finance, you need to get your customer, you need to build a product, you need to look at the office, you need to do all the admin stuff, you need to hire people. So it's very interdisciplinary in any case, right? Your learning capability needs to be very, very high. And so at Founders Talk, what we want to do, or what we've been doing for the last whole year, since last July, is we've invited people who are actually doing things, either investors such as Narayanan, Sanjay Mehta, or founders like Ashish Goyal, Akshay Mehrotra, Ravi Nigam, or ecosystem partners like Wadhwani Foundation, or educators, like Saraswati, all around, right? So what we've tried to do through Founders Talk is to essentially invite people and who know a lot and who've worked in a particular topic, and get their experiences, their expertise, their insights through a 1 hour conversation. And today we have, one such person, Narayanan Muralidharan. He is the vice president, operates in the venture capital industry, private equity at Patni Wealth Advisors. This is the Aryant Patni group. Aryant Patni is also from Babson College. I'm from Babson College. So that's how we got connected. And then I guess that's how Narayanan and I got connected a couple of years ago. Narayanan has previously worked in various startups. He's worked at Flipkart, then even at large companies such as EY. He's passionate about football. Always good to see, sports. I think sports are a necessity because it brings out not just the fight and the competitiveness, but it kind of also helps you deal with failure really well, right? Because you can't win every game. And in entrepreneurship, I think this is what we were talking about just a few minutes ago, that many of the founders that we've invested in have gone through a lean patch, but they still struggle on. They still try to, work through, not give up, come back stronger and build on what they have with the constraints that are there out there. Narayanan has invested in various companies such as Skillmatics, Trippior, Healthy Cravings Company, amongst many others. When I reached out to Narayanan, my thought process was very simple. We have a lot of great talent. We have a lot of student entrepreneurs. India roughly has 450 incubators, accelerators. We have roughly 3,000 odd investors investing in the venture capital, private equity. Those are the registered numbers. I don't know how many are really active. I'm assuming about 300, 400 people are active investors in startups in India. So fundraising is important. Money is important. Sometimes, you can build a fantastic profitable business, which takes 10 years, 20 years to be as large as a few thousand crores or a few hundred crore. But then there's another way, which is the venture capital way, which is for high growth companies. What does high growth mean? Paul Graham, who founded Y Combinator, typically says, a high growth company is someone which grows between 3% to 5 or 8% week over week. Right? I mean, those are some ridiculous numbers when you compound it over a year, over 2 years, over 3 years. So, when you're growing that fast, you need that much money as well. You need those many resources, you need those many people, those many experiments. And so, I hope Narayanan is able to give us an insight for idea stage, for product stage, for early revenue startups. How does he look at them? How does he do the due diligence? What are some of the things that someone looking to raise in today's COVID crisis, which has a lot of capital? I mean, we are seeing IPOs go 5x, 10x on one side, and on the other side, founders of early stage startups saying, well, there's not really enough money for when I go and knock the doors of investors. So welcome, Narayanan. A longer introduction, but I thought I'd set the context for you. This is the last of the Founders Talk webinar series. I wholeheartedly appreciate you taking time on a Wednesday evening to join us and share your expertise and your knowledge. It means a lot to me, and it means a lot to Flame University. And I hope we are able to have a conversation. The guys in the audience, you have a Q&A box at the bottom. Just put in your questions. We'll bring them to Narayanan, and he'll do the best in terms of answering those questions. So I'm going to stop sharing my screen. Welcome again, Narayanan. Please, feel free to share your screen and walk us through the investment perspective.
Oh, thanks, Darshan, for having me. I think it's always a pleasure talking to you. So let me do this. Let me just try and share my screen first. Let's see. This is if I get this right. Are you guys? Is this good? Hey, can you hear me?
Yes, it's good.
Yes.
Okay, perfect. So I'm just gonna just give me 1 second. I think I've lost my screen here somewhere. Just give me 1 minute. There it is. Sorry about that.
I think we can see your screen now.
Yeah, got it. Great. So I think we can spend hours and hours on end talking about fundraising and talking about the workings of the investment ecosystem. And there's a million and one videos that are out there that give you information on the do's and don'ts of fundraising, and some version of it in that sense. So I don't think there's anything that I can add to those, to be honest. So I thought, why not keep things interesting? And we put an investor's lens on what a fundraising process looks like. Give you a peek into what drives the decision-making process in terms of how investors would think about each aspect of a particular business. Because as you rightly said, I've been on the other side, and I know how absolutely frustrating it is that when your business is solid and you're certain that for some reason you just can't get the check in, until it finally does one fine day. And hopefully today we'll be able to, after our conversation, we'll be able to give a better idea of why it happens, and then people can sort of get better at interpreting the feedback that they get when speaking to investors and sort of adapt their fundraising strategy accordingly. So that's the overall sort of intent for today. And I'll try and use as many real life examples as possible so that we can keep it relevant. And so yeah, that's one thing. And so before we start out, I think I want to call one thing out, that I am as much a student of the subject as anyone else. And I'm not claiming that what I say is the only way things work, because I'm trying to generalize a very, very individualized concept here. So with that, let me just start off. I think the first thing that I want to say is, when it comes to fundraising, I genuinely believe that there's more than enough capital available out there. I don't think capital availability is an issue. I mean, just look at the numbers. I know you said that there's about 3,000 or 3,000, 4,000 registered investors. I haven't done my diligence on these numbers. This is from Traction. It says there are 909 active investors that have made an investment in tech in 2020 in India across 1,100 rounds of funding and $11.5 billion of investment. So it's not a question of availability of capital. I mean, it scares me sometimes, that the amount of dry powder that's available out there and the impact that it has on driving unrealistic valuations on occasions. I mean, but that's a conversation for a different time. I think that the bottom line of what I'm trying to say here is there is a lot of capital that's available out there today, and there isn't a dearth in terms of ability or intent to invest either, and that's across the spectrum. Right from the time you have an idea or to the point where you are gearing up for an IPO, right across that spectrum, there's a bunch of investors who have the money and who have the willingness to invest. So with that, I'm just going to move on to the next part of things. Irrespective of the stage or category of investors, be it equity, debt, strategic investors, I think the bottom line is every investor wants to create value for themselves. For a financial investor, it's very easy to translate that concept into something measurable. That measurable metric is the exit multiple on the investment. If I put in $100, can I make 1,000? Can I make 10,000? I think that's a very simple 1:1 translation. For a strategic investor, it's a little more nuanced, where investment in one company might not necessarily be for getting an X amount multiple out of it. It might just create a lot more value in another allied company. Not to complicate things, what I'm trying to say is everybody wants to make money, and that's why they're in this. And the decision to invest comes down to one question: is the potential return that I'm going to make from this investment justified by the risk? I think that's the way. It's a very simplistic view to take, but to be honest, that's the bottom line. And everything else that is done while evaluating investment opportunities is to try and validate our hypothesis on what the risk adjusted return profile looks like, and how our specific set of constraints, whether it's exit horizons, allocations, access, expertise, ability to influence the outcome, whatever. I mean, it's how our constraints interact with that and with that risk return profile, and how we are able to better manage that risk. I think that's the framework that I want to work off today. The engineer in me would call it an optimization problem with the objective of maximizing the risk adjusted return, subject to the constraints that we have. And it's these constraints, that are the essence of our conversation now. When I say return here, I mean, there are multiple definitions of return, and we alluded to that a little bit earlier, whether it's the multiple that we get, whether it's the IRR that we get, whether it's a higher market cap in a different company, whether it's access to new markets. There could be a variety of definitions for return. But the bottom line is, let's maximize risk adjusted return. So that's the context of I thought it'd be important to set context for this conversation before we move on. So with that context, let's talk investments. Essentially, why an investor would invest in one particular company and not another, or why a particular company gets funded by a specific investor and not others. And we'll use this risk adjusted return framework along with constraints to sort of address this conversation. So it's it's said very often, but I want to sort of repeat this, that not every investor is equipped to invest in every company. I mean, it sounds very intuitive, but it's something that I want to say out loud. Looking at this from the risk versus return lens, all investors won't ascribe equal weightage to the same risk criteria because of the way they're structured, or what the specific expertise they have. There are some risks that one set of investors can better dimension and mitigate compared to others. And I'll take a quick example here. So take a deep tech company that has managed to develop and patent an enzyme that converts methane to edible protein. Like it's so, the idea is so out there. It's truly deep tech. The idea is that, you know, we have excess methane gas, we'll use it to make protein, and we'll use it as a protein substitute to make animal feed. It's really exciting. And you know, conceptually, if you just from a little background about the animal feed industry, it is a multi-billion-dollar industry globally. Access to good quality, cheap raw protein for feed is a very big problem given environmental restrictions. This company has very strong patentable IP. I mean, what's not to like here, right? The potential for returns is obvious. It could even become a unicorn in a couple of years. So everything seems great. So let's flip it. The return profile seems amazing. Let's flip it around and let's talk risk. From a product standpoint, lab tests will tell me how good or bad the product is. So I am not too concerned about that. If I was looking at investing in the company, I'd diligence the product before making an investment. But the bigger question that I would have here is about the company's ability to sell the product. Conceptually, it's a great product, but the actual process of educating consumers, moving the product, and getting it to market is a much more nuanced problem, especially in a market that is highly dependent on on-ground distribution networks. Now, this is a very significant risk for me, and one that I need to be dead certain about before I sink $50 million into building a plant. And how I would sort of try and get comfort around this problem, comfort around this very, very young company who've got a pilot plant ready, who are manufacturing maybe 8 kilos of product out of that plant, who want to then take it and scale it to a 200,000 tons per annum capacity and want to sink $50 million in it. The way I would try and qualify that risk is to get some comfort from their potential clients that there is demand for this product, that they are willing to use this product. And that comfort is going to be in the form of signed letters of intent or purchase orders or whatever it is. And that's still a major risk, you know, because executionally, we've all seen that a signed letter of intent doesn't really mean anything. It can easily be reneged on. So it's a very, very big risk. And if that $50 million goes into building that plant, there is still a significant amount of investment required into building the distribution channels, acquiring customers. So it's a highly risky proposition. It's got a great return profile, but it's a highly risky proposition. Now switch positions with me and consider a global agri-inputs major in my place. They already have the supply chain and the customer base built up. They can leverage this to move the product. It is so the way they qualify this risk of getting this product to market is very, very different from the way I would look at it, because their ability to accurately measure a customer's intent to buy and then, of course, influence the buying decision would help them move product a lot quicker. They would get a lot more comfort around the risk that actually exists. They can measure this risk a lot more accurately, and they can help the company grow a lot more capital efficiently. So clearly, compared to me, they are much better investors. And by the way, this is a real case. This is about a company called Calista, and Cargill invested in them. This is from about 2017, I think. And the reason Cargill invested in them was to augment Cargill's existing product lines and make a more robust portfolio that they can offer to their consumers. And the value created for Cargill here was in a larger share of the customer's wallet and a higher customer retention. So I know I digressed a little bit over there, but I hope this gave you a little bit of flavor in terms of how people ascribe different value to risk. Basically, what I'm trying to say here is that every business is investable as long as the risks associated with it are palatable to me. So now that we've got the basics sorted, where investment decisions are based on risk-adjusted return expectations and different investors dimension risk differently. Let's take the conversation back to constraints, because as I said earlier, these constraints are the essence of our conversation. So what I'm going to do now is I'm going to dedicate the rest of this monologue to talking about various constraints and how they influence the risk profile and the investment decision eventually. Because the constraints that we're going to it's not just about how good or bad the business is. It's not just about how strong the upside potential is, but it's also about the different constraints that an investor has apart from being able to evaluate the quality of a business and in terms of making the final investment decision.
So Narayanan, sorry to interject. We are also getting questions as you speak. Should we bring it to you now or at the end?
I am happy to do that now as well, as you'd like.
Great. So the first question really is around, you've spoken about non-tech products. But for a tech product, how do you evaluate risk and return, and maybe some numbers around the expected return as well?
Right. So, in terms of expected return, every investment that I want 100x on it. I mean, that's the lens that I would approach every single investment. But that said, it's the fact that any investment that has the potential to give me 100x is also a highly risky investment. And I mean, it's an often quoted metric that 95% of all startups fail. So the approach that I am looking at is a portfolio approach. If I have $1 million to allocate, then I'll allocate 100,000 across 10 companies and try and build a portfolio which can then give me an overall IRR of maybe 55-60% over the course of the next 6-7 years. I think that's one. I mean, that's the way I would look at every company. So every company that has the potential to do this, I would invest. Secondly, when you're talking about tech products, so honestly, this when I speak about Calista and Cargill, that technically it is tech because it's biotech. But I guess what the question was with respect to something like an AI product or something like a B2B SaaS company. Am I correct in understanding that?
Yeah. So any technology company, maybe a SaaS company or a consumer tech company.
Sure. So let's take something like a SaaS company, because SaaS is a lot closer to my understanding. And let's take the case of Tripure for that matter. When I met the founders, the company was fairly young. It was a question of they demonstrated the product. We were able to sort of test it out, do a thorough tech diligence in terms of how well architectured that product was and everything around that. So there was a good amount of comfort around the business at that point, around the tech product at least. The bigger question was again go to market. Travel OTA is a very, very crowded market. It's highly fragmented. You have Make My Trip, and you have the bigger B2B guys like Amex and whatnot, who have cornered the larger enterprise share of the market. I think where we got comfort in this was that, including us, a couple of other investors around the table as well were able to influence and get this business, get this company into doors and get them into conversations where they could then pitch the product and get more business. So there, for me, the comfort was not around the fact that it's just a great product. I think it was a lot to do with the fact that I have a lot of control and a lot of visibility over how this company is going to get more business, versus somebody else who doesn't have that visibility and is just evaluating it on the product itself is going to consider it a lot more risky compared to what I am, because I know where this guy is going to get business from. Does that answer the question?
Absolutely. Thank you.
Cool. So I'm just gonna continue from where I left off. I think, and we were talking about constraints. So I'm just gonna share a quick laundry list of the typical constraints that one would look at, and there's a bunch of others but these largely cover most cases. So I'm just gonna focus on these. Um, so you've got strategic intent, you've got investment instrument, you've got sector expertise, you've got stage allocation, exit horizons, and we'll get into each one of those separately. But broadly, all these constraints put together is what you often find a fund saying that we have, this is our thesis. I think a different way of looking at a fund thesis is how a fund's unique set of constraints influence its investment focus. That's a very elegant way of looking at a fund thesis. So the first couple are fairly easy to understand with strategic intent and investment instrument. Um, so let's get strategic intent out of the way first. Every investor has an overarching intent that acts as a sort of first level filter in sourcing deals and then spending time on opportunities. Like in the case of a financial investor, that's fairly straightforward. Make investments in opportunities that can yield the maximum risk adjusted return. In the case of family offices, it's a little more it's a little more fluid, and it can evolve at any given time. But that's the starting point, knowing what you want to do. So let me take an example. There's this family office that I know very well. That's not us, by the way. And I won't say who it is because it's not my place, but this office has a very focused strategy of investing only in businesses that complement the core family business. And the core family business, for that matter, is in hardware and electronics. So it's built on the knowledge that they have a very, very strong ecosystem in the sector, and they can leverage it to rapidly scale up any new business that they invest in. So if they were to get the opportunity to invest in SpaceX, they'd actually say no. Not because SpaceX is a bad company, it's just that it has nothing in common with the family business, and it's not. That's not what they are here in the market to do. SpaceX has a million other investors that they can go to and get money from who are much better suited to doing this. So that's basically strategic intent. Let's say an opportunity passes that intent filter. The next one is in the type of instrument. Am I looking to invest via debt? Am I looking to invest via equity? Am I looking to invest via something in between? And I'll take another example here, a quick example. It's let's say I'm a consumer investor, and I've got an opportunity to invest in a major furniture rental company. They're looking to raise X amount of debt to finance the new furniture that they need to service the growing demand. The debt is collateralized by the furniture that is being bought. The company is growing well. They're burning cash, but they're still growing very, very very, very nicely all the same. And the expected IRR on the debt is 20%. Like 20% on debt is unheard of anywhere. But I'd not even spend time on this and say no. And I know this comes across as very stupid on my part for turning down what is clearly a good opportunity. But when we take a step back and think about it, I am an equity investor. That's my DNA. I'm prepared to take on that higher risk for the higher potential return. And we spoke about a portfolio strategy 5-10 minutes ago, wherein it's not on a company basis that I'm looking for success. I'm looking for success on a portfolio level, wherein my entire portfolio is trying to yield 50-60% IRR. And that's how I have built a diversified portfolio to optimize for the risk-adjusted return. Additionally, I'm not really equipped to evaluate the risk of this debt, because that evaluation would be based on the ability to project cash flows and a bunch of other considerations that I have absolutely no expertise in. And evaluating debt is so different from evaluating equity that I don't think I can translate my skill sets to accurately figure out whether 20% is a steal or 20% is absolutely rubbish. So when I look at it from that concept, from that context, and not just as a standalone opportunity, the decision to not invest makes a lot more sense in that over here. So again, I'm just trying to sort of give a little context here in terms of it might be a great company, but it might not be the right company for me, and hence I won't invest. So we've covered intent and instrument at this point, I think. And these are very high level constraints. Usually it takes about 5 minutes to decide if the opportunity on the table fits with these constraints, and there's no gray area here. It's either it fits or it doesn't. Once an opportunity has qualified these criteria is when things start getting interesting and a lot less clear cut in that sense. And so let me going back to that conversation about the number of financial investors out there and stuff around that. I mean, we spoke about 1,000 odd deals happening across with 11 billion plus in investments in 2020, and that's in the most uncertain and bizarre year that we've ever seen. The last 12 months have been a complete washout for so many businesses. So many businesses have shut shop, so many businesses have pivoted, and yet we are seeing 11.5 billion in investments across 1,000 odd deals. And those are the ones that got funded. Now, if even one out of every, say, 20 investments gets funded, I'm looking at 20,000 deals available out there in the market. If every investor tried to evaluate every deal across every stage and every sector out there, they'd go nuts. I mean, they need some structure and some framework to cut out the noise and whittle down the universe of companies that they're looking to evaluate to a more manageable number, and then sort of invest in the ones that represent the best risk-adjusted return. And this is where the other constraints play a key role. And these constraints are unique to each investor, and they combine together to give that investor his or her unique perspective on the risk of any potential investment. And everything else that is part of an investor's thesis or a fund's thesis, whether it's sector, whether it's stage, whether it's business model, whatever it is, it all flows from this. So I'll give you another example here. Take myself and another close friend of mine. We both went to college together. I have an engineering degree. I have worked in data sciences and consumer businesses. And as a function of working under someone who had a strong B2B thesis, I've also learned the nuances of how B2B enterprise models work. Basically, what I'm trying to say is I understand these businesses fundamentally a lot better as opposed to, say, something like medical devices or agri-tech. So even though we as a fund are sector agnostic, most of my investments will have a strong D2C or data connotation. And additionally, by virtue of my personal experience operating in this space, I've sort of built a strong ecosystem of partners, whether it's in digital marketing, product development, enterprise sales. So there's a network that I can leverage to add value to companies early on in their journey. Things that would normally take companies a lot more time and effort to figure out on their own. So, for example, one of my consumer companies, which relies on offline distribution, these guys make sanitary napkins and have now recently evolved their product line to sell pet shampoos as well. But I was able to sit down and sort of help them design and build an in-house sort of database solution that gave them very clear visibility of what is selling where, how efficiently their feet on street are performing, and more importantly, sort of profile demand from different areas so that they can more efficiently target their expansion spend. There's no point opening a shop, placing product in a shop where you see one sale in 20 days versus sort of focusing that same energy on a shop where you see 20 units being sold in one day. And that was a very data driven sort of approach that we were able to do. And they would have managed to do this themselves, there's no question about it. They're a really smart bunch of folks. But I guess what we were able to do was help them do this in 2 months versus the 6 or 9 months that it would have taken them. And for an early stage company, that's a lifetime. So,
Narayan, I'll just like to interject you here. So we have a question from Dhyanesh, almost on the same lines, which was on, how important is it for a founder's qualification or experience while you're evaluating that startup for investments? So while this covers, is there a certain preference that, you have to have this sort of a background to start this startup, or is it as agnostic as it can be?
So I think I'll give a longer answer to this as opposed to just a quick yes or no. I think where your education is from doesn't really make a world of difference to me, but what your background is does. Because if you're building, let's say, a natural language processing product, but have no experience in coding, don't have any experience in building a proper tech solution. Now, whether that's via education or as a function of working for a company where you build something like this, and if I don't know you, if it's a very, very young company, the biggest risk that I have is the product risk. I mean, how do I gain comfort that the product that you're building is actually going to be of the quality and the standards required to crack it, not just in India, where realizations of tech products are anyway low. If you want to sell tech products, end of the day, at some point, you have to be in Southeast Asia, you have to be in North America to sort of meet quality standards for those markets. I'm just trying to build comfort around that when I look at what your educational background is or what your work experience is in that sense. So if there is some other proxy that I have, I know of a whole bunch of people who are self-taught coders, and I know a whole bunch of people who have done good stuff. So if you have built, let's say, just as a hobby as well, if you've built an app for something, or if you've built if you've helped another startup in terms of their in terms of building their product out, whether as a product manager or whether as someone who's actually sat down and coded, but that sort of helps me get comfort that there is a core skill set that is required for the success of this company that the founding team possesses. I think that's what I'm trying to get at.
Okay, I think that sort of answers as well.
Fair enough. So I think I was talking about Urban Essentials and the data product that we built for them together. So when you put all these things together, right, the experience, expertise, ecosystem, from an investor standpoint, it becomes very, very clear that I should be focusing on early stage investments that leverage on data or D2C. And this is unique to me. My friend who I was speaking about, who graduated from college with me, who's also an investor, has spent time with the education consulting practice at Parthenon. His view on the stuff that I invest in is very different from my take. And when it comes to education, he understands the space inside out. He has connects with universities, schools, other stakeholders that I can't even fathom who else is part of that ecosystem. But he has that ecosystem tied down so well that he can leverage this to ensure the success of his portfolio companies in that space. So what I'm getting at here is the stuff I invest in might not be relevant to my friend and the other way around. And I'm not saying people can't learn about new sectors or build thesis around them. Just that in case you're pitching to an investor who's not yet done that for your sector, it's quite likely that they won't invest irrespective of how good or bad your company is. And I'll give you a very specific example again in my case. And this is to do with social networks. In my career, I must have evaluated more than 50 social network startups, including the likes of ShareChat, including the likes of Trail, including the likes of Chingari. that have gone on and become incredibly successful. And if you come to think of it, social network is a very competitive space. The technology is to very, more or less commoditized as of today. Anybody can build apps. And any innovative features that you might have, like for example, Snapchat had those stories which then Instagram copied and then Facebook copied. So any features that you might have get replicated in next to no time. So what makes a social network successful is something that I have no idea about. I've read the case studies, I've traced the growth trajectory of Facebook, Instagram, and every other social network out there. But I still don't have a reason I can point to and say, this is why this company was successful, or this company will be successful going forward with any degree of confidence. So does that mean social networks are bad businesses? Clearly not. I mean, you just look at the likes of, again, ShareChat, Trail, and a whole bunch of other Indian social networks. It's just that I'm not the right investor for this industry, given its structure and my inability to understand the risks associated with it. And sector expertise and ability to influence outcomes. I know we've spoken a lot about that, and that's just one layer, Now, you take the case that we just spoke about, and about social networks, and say I spend time and learn and, learn all I can about social networks and figure out the secret sauce. Social networks are, that's fine, great. I now understand how social networks work. I am ready and geared up to invest in the next good company that I find. But here's the thing, social networks are high burn businesses. The secrets of a big part of social networks is to acquire customers, engage them, and then monetize them. So you need to spend a lot on user acquisition and engagement, and there's nothing wrong with that. But anyone who's ever remotely been involved in a startup in any capacity will agree that things never go to plan, like never. And I can say with a high degree of certainty that there will be periods where the company is figuring its stuff out, and there is still a while away from hitting the kind of metrics that they need to get their next fundraise in. But it's in that sort of uncertain period where you still need to continue spending, to continue doing what you're doing. And so here's the thing, right? Even if I understand the business, I have to consider if I have the pockets to support this till it goes to the next level. Because again, I'm looking to build a portfolio. So I cannot disproportionately allocate 50% of my fund corpus to one company, right? So just from an allocation perspective, it doesn't end up fitting. Like you take this case where you're raising 4 million for a runway of 12 months and you're diluting 25%. You're burning 350,000 a month. If my upper limit of investment is 500,000, and say I put in 500,000 in that 4 million round, and the company is running out of money, even if I do give them another 500,000, they're going to spend that in 1 month. So where does it go from there? So just from that standpoint, it really doesn't, it just doesn't fit. And the only way I would do this would be to co-invest with good quality partners. If there's an investor coming in that can help pick up the slack in these times, someone who has really, really deep pockets, someone like, say, someone like a Sequoia or an Accel, one of the really, really big boys of the ecosystem who can, drop a couple of million at the, at the flick of a switch and say, figure it out for the next 6 months again. But so let's say that's happening. Let's say I am co-investing with one of the big boys. But then does it make sense for me and not just for me, but for the founder as well, to add a relatively small check to the cap table? Because from where I stand, my ownership in the company will be relatively insignificant. If I've put a 250,000 check, which is right in the middle of what I do, my ownership will be 1%. And this will get further diluted significantly as the company raises more and more capital. Given that scenario, what is it that I stand to achieve in this? I will have next to no influence or control or where the company goes. My rights will be subordinate to the larger stakeholders, and that is fair because they put in a lot more money. They require and they should get preferential rights, but that said, my rights will be subordinate. And the fact that, exercising most of these rights, I will be subject to multiple approvals, while at the same time, when things go bad or if there is an adverse outcome, I am at the fallow end of the waterfall. After everybody else gets paid is when I actually get anything out of it. So when I put all those things together, I'm not standing on very firm ground here, where in the interest of the greater good, the really small investors might end up getting shortchanged. Not because anybody wants to shaft you or anything of that sort, but it's just because that's the best outcome that's on the table for the larger part of the cap table, and you're just the one who ends up with the short stick in that sense. And that's a very real scenario, by the way. We spoke about this, that 95% of all startups fail. There's a high chance of this scenario playing out. So, even if I understand the business and everything else is great, just structurally, I would think long and hard before doing something like this. And I'll flip this around as well from a founder's perspective. What is it that I'm bringing on the table that you actually want to add another small investor to the cap table and complicate things going forward? There's one more investor to manage. There's one more investor to engage. You'll have to continue to wait for their signatures on whenever you're doing any paperwork or anything going forward. They have the potential to throw a spanner into the works when another investment round is happening. Unless I'm someone who's actually built out a social network, let's say, unless I'm Mark Zuckerberg, there's really no reason for you to want me on this cap table. I really don't add any value. So to sum it all up, what I'm trying to say here is that there's a bunch of considerations while evaluating a business. So qualifying the business's quality and the financial potential is one thing, but that's just the start. That's the core of what you do, but it's still only the start. It's so often that I come across really brilliant businesses with great teams, but just structurally it doesn't make sense. For one of the reasons that we've spoken about, there's a bunch of other reasons that we really don't have the time to get into today. But it sometimes just doesn't make sense for that. So it's not that the business is bad; it's just that it's not the right fit for me.
Narayan, also, I think in the interest of time, I'll just let all the participants know, in case if you have questions, please keep putting them in the Q&A so that we can weave them into the conversation. We're already at around 5:50, so we don't really, move over the board as well. Thank you.
Sounds good. And again, just in the interest of time, I know this is the last part of what this is the second last part of what I was going to talk about. This is the more important part, so I'll sort of keep it at that. So we've done the hard yards. We've figured out that there's a business we like. The numbers make sense. There's a great rapport with the founders. We've got a plan of how we can build this business out. Everything is sorted. Great. Let's invest. Not yet. And I know it's really infuriating, but I think it's very important to touch upon documentation and some rights of that investors ask for at this moment. And the reason I'm getting into this is because of the why of these rights are important to investors. One of my early mentors used to always say, when everything is going well, you don't need to care about documentation. But when things start going bad, it's best to have these things pre-agreed so that you can focus on getting the business back on track instead of then trying to figure out if things get worse, who gets what and what happens and stuff around that. And personal experience says that people are always more giving and more equitable and fair when things are going great. I'm not saying that you don't trust your investee companies and founders. I'm just saying, just clear out the roadblocks before things get bad. And I'll just quickly get into the documentation part of it. And there's about 6 rights that I want to talk about here that I always hear pushback from a bunch of founders, because on the face of it, they appear a little onerous. But what I'm trying to do is here is sort of give the investors take on why these rights are really, really essential, and the deal doesn't happen without them. So the first one is preferential rights, and this is easy to understand. In the event that another investor, typically a follow-on round, in a follow-on round, they're asking for better rights or preferential rights. It says that I get the same rights. And the reason for that is, I don't want to delay that process and at the time of a new investor coming in and then sort of end up renegotiating with the new investor and with the company for each right which I've already negotiated to begin with. So I am sort of trying to preempt that scenario. And the reason why I am so clear that I don't want to do that is because going for it's fine, I want to get the investor in. It's all I might even agree today to giving somebody else preferential rights. That's fine, but 3-4 years down the line, in the event of a liquidation or in the event of an acquisition or an exit or whatever it is, I don't want there to be a misalignment of interest between myself and everybody else on the cap table, wherein doing something is great for them but not great for me. So to sort of preempt situations like that, I want to make sure that everybody has the same rights. And that's why the preferential rights clause goes in, that if somebody else gets better rights, then so do I, because then it sort of brings everybody onto the same page and everybody is acting with the same intent and the same sort of incentives and disincentives. So the next one is with reserve to reserved matters. Again, it's a fairly simple one to understand. Basically, I'm making an investment in the company based on certain assumptions and promises made by the founder. I cannot be in a situation where after the money comes in, the founders and other stakeholders sort of unilaterally make decisions that impact my interests. So, it just the intent of this is basically to say that in key decisions that impact the company and my interests, I want to have a say in it. So, for example, taking an excessive amount of loans or selling off some asset or IP, the intent is not to interfere with the daily working of the company. The founding team is the best suited to run the company. And, if we didn't believe that, we wouldn't invest in them. But the intent is to have some sort of accountability and to ensure that, at least I have a say when it comes to protecting my interests. So that's the basic reason of why reserved matters goes in. It's just to make sure that nobody unilaterally acts in a way that is counter to somebody else's interest. The next two I think I'll take together. That's anti-dilution and liquidation preference. And I've heard arguments that anti-dilution is an unfair ask. That if an investor is investing in a company after valuing it at a certain valuation, they shouldn't be seeking additional downside protection and a bunch of stuff around that. And I understand where the founder is coming from. But there's two reasons why this clause is important. The first one is to make the deal happen. It is often the case that I like the business and the founder, but the business plan that they are projecting depends on a lot of things going right very quickly. And the founders are married to the valuation expectations. They genuinely believe in their business plan. They genuinely believe in the model. They genuinely believe that they will achieve 10x growth in 6 months. And that valuation that they're asking for is absolutely fair if they were to achieve that growth in 6 months. Now, there's no harm, and honestly, I don't see any harm in a founder being a little ambitious and a little hungry. I actually like that. But I don't want to walk away from the transaction because it's a good company, it's a good founder. But at the same time, I'm not as carried away by the enthusiasm that the founder has because I have some real concerns. So to make the deal happen and to bridge that gap between the expectations of the founder and the concerns that I have, what I basically do is I ask the founder to underwrite the optimism. I'm basically saying that you're confident of achieving these numbers, which I am concerned about. So, which is fine. So let's meet in the middle. If you achieve these numbers well and good, there's nothing untoward that happens. But if you don't, and the company needs to raise more capital at a lower valuation to get back on track and needs to restructure things, then I want my concerns to be validated at that point, and I want the price of my shares, the price at which I got shares, the effective price goes down. That's basically the intent for anti-dilution. It's not to make it onerous on the founder. It is to make the deal happen essentially and bridge that gap. The second one is a little more sinister. The second reason, and I'll take an example to sort of convey this here. Say I invest in $1 million in a company at a 10 million valuation. I own 10% of the company, and my shares are worth $1 million. If in the absence of an anti-dilution clause, say 6 months later, the founder gets his cousin or his chacha or whoever it is to invest $90,000 at a 100,000 valuation. The company gets diluted 90%. I own 1% of the new company, and my shares are worth $1,000. So I've basically given away $1 million for nothing. And this is crazy. So to protect myself from something like that, and again, this is an edge case. I've never heard of something like this happening, to be honest. But it is just to make sure that such an eventuality doesn't ever pan out. The next one is liquidation preference. Again, I've heard about similar arguments for this. That it's too onerous and unfair. That if you've invested in the company, why should somebody get preferential payouts in case of a liquidation event? And again, take the situation where I've invested $1 million for 10% of the company. The company is growing steadily, not at the pace it was expected. It's profitable, it's self-sustaining. And to keep things simple, let's just say I own 10% and the founder owns 90%. And the company's been doing this for 4 or 5 years now. And the founder sort of, tried everything, but lost that energy, lost that passion, doesn't seem to be going anywhere. It's a good lifestyle business, but it's not really a hyper growth business in that sense. So now that, let's say 4 years down the line, and there's an offer on the table where somebody wants to buy the IP of the company for $5 million. Now, in the absence of liquidation preference, the founder gets $4.5 million. He gets a job and he gets a fat paycheck that goes with the job, while the investor takes a 50% loss on the capital committed. So that is not really an equitable outcome in that sense, especially for the investor. So LicPref, what it does, and LicPref is usually at 1x of the investment amount. It just says that, it makes sure that the founder has an incentive to get fair valuation of the company. Second, to do whatever they must to get this company to the next level, instead of taking the easier and more and on most occasions the more lucrative way out, and say that I'll make money, the investor can figure out what they want to do. So it's just to do that. It's just to make sure that again incentives are aligned. It's that the founder and the investor are on the same page. The final two being drag and exit. I think again these two are fairly simple. The drag is a little not contentious per se, but it's a little. It has some negative connotations because it kicks in only in the event of some negative of some default by the founder that has a negative impact on the company. Whether it's fraud, whether it's misconduct, whatever it is, and to sort that mess out, if then as an investor I need to compel everyone else involved to sell shares to a potential acquirer or whatever it is, then I should be able to do it, because the intent here is to protect the investor from willful mischief by the founder. That's it. Basically, it says trust but verify. That's it. That's the intent of doing this. And in terms of exits, I think very simple. Again, I hear people saying that you shouldn't rather have something like this in, because you really can't dimension at an early stage when a company will exit and whatnot. But unfortunately, every fund has a life cycle. It's a 7+2 or an 8+2 year life cycle, wherein eventually you have to return capital to investors. And it has to happen before the fund life cycle ends, or else you are legally in a lot of trouble. So I guess that the intent again for something like this is not to force the company into into a corner and sort of get a multi-bagger return out of it or anything of that sort. It's just about getting out when you need to and making sure that the company helps and assists you in doing that, so that you can legally, you can discharge your legal obligations towards your LPs when the fund life cycle ends, and you're sort of able to pay them back. Whatever that number is, you might end up getting zero out of it, which is fine, but that it sort of goes to a conclusion in that sense. So I think that's more or less what it was. I'll just take a couple of minutes to quickly summarize what we spoke about. We spoke about the different types of investors and instruments, and I'm happy to share this deck with everyone involved so that they can go through this at leisure. But basically spoke about the different kinds of investors, whether it's equity investors and PE/VC funds, whether it's family offices, whether it's strategic investors and debt funds, and how they're different from one another. We also spoke about different kind of instruments, whether it's risk, whether it's equity or debt, and what the risk return expectations are, and there's a little bit here about the implication of those things on the company as well. I think this is an important one to look at. Again, this sort of summarizes the different stage of investment. I know we had a question earlier about how one would qualify as a risk for something like this. So it basically talks about the different stages of investments, and what are the key risks that one observes typically at such an investment. I think one thing that I want to call out here, and again, not a big thing, is that the kind of risk, as the company grows and the company evolves, the nature of risk that the risk goes down. Of course, as the company becomes bigger, the risk goes down. And second, the nature of the risk the investor takes on also evolves quite significantly, because if you look at a company, let's say in the early stages, whether very, very early, it's raising their angel round or seed round, the bigger question is around product market fit. The bigger question is around scalability. It's around revenue model. It's not about it's not about how whether whether you have the right controls in place, whether there's fraud going on. It's not about whether you're managing your receivables correctly. No, it's just about whether you can build the right product. Whereas if you look at the other side of the spectrum and you look at private equity businesses where the revenue model is very well established, the product market fit is established, the company is already of a significant scale. Here the question is more about how profitable can you get, how can you optimize costs, how can you optimize operations, what other avenues do you have of, you're already doing $500 million of revenue. Can you make this 500 to 600? The conversation is very different. The kind of risks that you take on are very different. And there's different kinds of investors who are better suited to take up the different risks. So I think that's more or less what, I wanted to sort of touch upon today. I know we've sort of run over time a little bit.
I think it's okay. We almost have everyone here with us as well. Just a few questions before we sort of wind up as well. Yeah. This is going to be more from the Patni Family Office. As such, what stage does the Patni Family Office invest in startups, and what is the typical investment size that one can expect?
Right. So, and again, given that we are a family office, our strategy is a little more fluid as opposed to, say, someone like a Sauce VC, which is early stage angel consumer. That's very, very focused. For us, I think, but I'll still do this. I'll try and give as concrete an answer as possible. So we look at ourselves as early stage investors. So we would typically come into the first institutional round that a company is looking to raise. We are sector agnostic, but that said, as I said earlier, there is a very strong D2C and a B2B enterprise and data connotation to what we do, and that's just a function of our experience. But we typically come into the first institutional raise that a company is raising, happy to lead, happy to co-invest. Really depends on the nature of the round, the quantum of capital required, who else is coming in, and more importantly, do we feel we need more intellectual capital around the table? Do other investors who are coming on board really add value? For example, when we did Skillmatics, we actually made room to accommodate somebody who had a very strong background of doing an outsource, not an outsourcing business, but sort of manufacturing in India and selling in the US sort of a business. And we really wanted this person on the cap table. So irrespective of whether they put in 5 lakhs, 10 lakhs, we just wanted to have that person for their expertise. So we made room, just as context. But that's, so, typically early, first institutional round of the company, and have some, and we don't do idea stage stuff. We just feel that we're not equipped to deal with that. We just don't have the bandwidth to provide the kind of support that an idea stage company requires, given that we already have 19 companies in our portfolio, and it's a small organization in that sense. We like to have companies that have at least the minimum viable product ready, and something that we can then gather comfort around in terms of product market fit. I think even pre-product market fit is fine as long as we are able to qualify that through certain proxies, but a minimum viable product is a must.
Okay, all right. So I think that's fair enough. And we also have a question here from Sumed, who wanted to know that for a new startup, what would be an acceptable equity percentage given to a VC? Let's say for a Series A fundraising as such.
So that's a very difficult question. It's and I'll give you context. Ola, when Bhavish raised his first round, he diluted 40% for, I would say, $1 million. And if I flip that around, and if you look at, something like a Clubhouse, which has been in the news fairly recently, they raised a 10 million round. Their first round was 10 million and they diluted about 10%, right? Similarly, if you look at something like a CureFit, and of course, CureFit is an anomaly because you have Mukesh Bansal and Ankit Nagori there who have proven experience of building out unicorns themselves. But Mukesh and Ankit, I think, diluted about 18% for their first 30 million check. And they had 30 million in the bank even before they started. So it's really fluid, But I'll give you a rule of thumb, I don't, in terms of an angel round or a seed round, I don't think there is any investor out there who will take less than 10%. Because, by raising more and more capital, you're going to get more and more diluted going forward. And the real opportunity to make a good outcome out of this only happens if you have a decent enough ownership. So I don't think there's anybody out there who's going to, and this is an institutional investor. Yeah, I'm not talking about friends and families. Friends and family, how much ever you can negotiate with them, please go ahead. I mean, they're people who know you. They should be trusting you enough. But for an institutional investor, I don't think anybody will take less than 10%. And I would be very, very, very skeptical of diluting more than 25. Because what happens is, and I've seen this play out, where you might dilute 25% now, but as you raise more capital and by the time you hit your Series B, the founder is at 20 to 23% and external investors are the rest, along with ESOP pools and whatnot. At that point, any other investor contemplating an investment is going to question whether the founder is incentivized enough to stay with the company. Because you have only 22% of equity in the company. Do you have the incentives to stay the path? So diluting a lot initially is not a great thing, but at the same time, I wouldn't chase crazy valuations early on as well, because early on it's not about the valuations. You'll get that at your Series C, Series D. Early on, it's about getting the right partners on board. Even if that means, making room, or even if that means accommodating at a 10% lower valuation, I think you should do it.
Okay, fair enough. And I think just two more questions if they can. We have one question from Ashima, who said that except for the investment, how else can a founder leverage the investor for the company's benefit? Is that something that can be legally protected as well?
Yes and no. Okay. So here's the thing, right? you can put in, and we've done this, and we've done this more with strategics than with financial investors. For example, yeah. So first things first, yes, you can leverage your investor network, and you should. If you are not doing that, then I think you've got the wrong investors on your cap table, because as on today, there is no dearth of money chasing startup investments. So you have a choice of who you bring onto your cap table. I think one should do their research and figure out who their A list of investors is, and then get them on board, because having the right partners really makes a world of difference. And I can't stress this enough. Having the right cap table can really be the difference between a startup getting acquired at series A versus becoming a unicorn. That's the kind of difference that it makes. And if we had more time, I'd get into it a little more, but just I'm going to ask you to take my word for it in that sense.
Definitely.
The other question that you asked is, how can you protect it legally? So I don't know if I specifically wouldn't go for any deal in that sense, and any paperwork that happens in India, I would take with a pinch of salt, because enforceability is a big question. But it's still a piece of paper. I think what you can do, especially with strategics, especially with people who come in demanding a lower valuation or demanding preferential rights on the basis of them being able to add more value, and you want to sort of protect that, and you are well within your rights to do so, and I think you should. I think their equity, the easiest way to do that is to have their equity vest depending on certain metrics. So, for example, if you're a B2B enterprise SaaS company, and there's an investor who comes in and says, I want to invest $1 million, but I want 20% of the company, even though your company is already valued at twice that. And you feel that there is a lot of value to this person, because this person is claiming that he can get you $5 million of business from Europe. Then, the way I would structure it is, I would say, fine, we'll accept your investment, but you only get 4% of equity for every $1 million of business you bring in. That way, it sort of protects you, and make sure that they are incentivized to get what they've committed in that sense. I think that's the easiest way to do it. The same way you do with ESOPs.
True that. And I'm gonna before closing the session, ask you one last question on how, in your experience, how have you come to define a successful VC investment? This is by Mansi, and I think a couple of others as well, but then I think we don't have time for that. But at least in terms of, if you have to label something as this is a successful investment that we've done, how would you sort of qualify that?
That's interesting, because success has different definitions at different times. And I'm being a little philosophical here, but if at the starting point of every investment I was to look at what defines success, I think the easiest way for me to say is how much money I made on that company. Is, let's say I invested X, did I make 10X? Did I make 15X? Did I make 20X? But the goalposts usually end up changing, especially in the backdrop of the year that we've had last year. And I was just speaking to Darshan before we started the session about one of the companies that we have in common, that's in the travel space. And travel was hit really, really hard. And so for the founder who was doing 5 crores a month in revenue, who was burning 50 lakhs a month, who was gearing up for a Series B in June, July of last year, and was essentially sitting on 4 months of runway when the pandemic started, for that person to still be in business and to be self-sustainable and to still be sitting there with the energy and with the hunger to say, we'll build this back out and we'll do this. I think I would call even that a success, just from where I'm sitting right now, because of what we've been through last year, right? So I guess it's a little philosophical in that sense. But if you're looking at just a data-oriented approach, then what's the money? How much money did you make on it? That's pretty much it.
Absolutely. Thank you so much, Narayanan. I think this has been such it's been a very different point of view. I think we've had so many sessions over the past few months on Founders Talk with respect to how to pitch in and what to do sorts. But I think understanding things from an investor's perspective also will help a lot of our participants chart out their plan as well. So thank you so much. We hope to have a much lengthier masterclass sometime, a much more detailed one, so that we can touch base on a lot of other things. For those of you who wish to probably access this, we will be putting up the recording of the session on our YouTube page. You can access that by tomorrow. And for other questions, I'm just putting in the PGPI email ID. You can write to them in case if you require any other assistance as well. Thank you so much once again, Narayanan, as well as the audience. You've been with us for the past so many months. Some of you have been practically been across all of our 10-13 sessions that we've done. And we look forward to hosting you for many further Founders Talk sessions as well in the future. Thank you so much.
Well, thanks a lot, Anju. And I hope I was able to do some justice to what.
Absolutely. I think. Thank you so much. Thank you.
Right. Thanks, everyone. Thanks for taking out the time.
Yeah. Bye-bye.
Take care. Bye.